So, folks, you probably have already figured out by now that there are many different valid approaches to investing. But whatever your methodology of investing, it is crucial to make sure that you do have a system in place to help you protect your positions and, more importantly, to maximize your profits. So, over our next hour, to help you understand investing methodologies better, Huan will be joined by 3 other experts from Phillip Securities. Mr. William Liu, who has his own YouTube channel at William Liu Investment, Mr. Louis Koay, who works with over 2,500 clients with his team and has trained more than 18,000 retail investors, and Mr. Terence Chua, who's ranked in the top 3 best analysts for energy and small caps stock counters. So, over to you, gentlemen.
Right, thank you, Edward. Right, so together with me, I have 3 other speakers, all right, Louis, William, and Terence. Right, so maybe I want to start with a short, brief introduction of your own investment experience and equities, or which type of clients usually you interact or engage with. So for myself, I will start off first. I'm from the Phillip Center. So normally I actually interact with more of the retail investors, all right, at the stock and at the branch level. So maybe William or Louis want to share first? William, maybe you're on mute.
Oh, sorry. Okay. Hi, this is William. I'm a remisier in Phillip Securities. I started my own trading journey. So when I was in national service, then after that, I joined Phillip Securities in 2015. So in the past 7 years, so my business has growing quite fast, and I became one of the top remisiers. I successfully built my own team and expanding my trading strategies based on technical analysis and for the past few years. And 70% of my clients, they are short-term investors, traders, and the other 30% are long-term investors.
All right. Yeah. Thanks for inviting me to share in this webinar. I'm Louis Koay, and I'm Louis. Right. So I will just do a very quick introduction myself, because nowadays you can just Google, just type my name, Louis Koay, on Google. You will find many relevant articles and even my own Facebook page online. Right. So for me, I actually a colleague of William. Okay, we actually our seats just side by side, right? And we joined the same in 2015 together. Right, but my strategy probably is a bit different, right? Because I'm more about talking about portfolio allocation, right? Because I also am a financial advisor to do financial planning. So I do have some clients that invest in stocks, bonds, ETF, unit trust, right? And I'm more a fundamental investor. So I pick company based on research article, financial ratio, and I invest. And then through the invest in those undervalued companies. All right. Yeah. So yeah, good to share more in this short sharing.
Terence, maybe you want to share more?
Yeah. Hi. Hey, thanks, Huan. And apologize for the background. There seems to be some problem with the background for me. So sorry, it's a little bit different from the rest of the audience. But hi, I'm Terence. I'm Senior Research Analyst with Phillip Securities Research. As part of my role, the research department, we churn out about 300 reports a year, covering a wide range of Singapore and US companies for the research team. So the approach that the research department have when we come to researching on the companies is to do a deep dive into the companies that we cover, and that usually means conversations with management, going down to their factory to have a look, and then performing a valuations analysis of the company, and then eventually we issue a call on the company that we cover. Yeah, so look forward to having a meaningful discussion with the rest of my fellow participants here on the panel today.
Yeah, thank you, Terence. So technically, because our session today is actually to share more on the investment methodology that maybe can help retail investors or the audience to actually learn more on how we actually consider investments. So actually, maybe I will start off with this question, right? So this question might be actually relevant to many of the investors, because how do you determine the percentage of funds that you have available that you will invest? All right. And then do you invest in only cash, or will you actually use CPF to invest, especially if you are going to buy a BTO or a house soon? So do you use cash or also CPF to invest?
Okay, how about I start first? Okay, for me, actually, I am a high risk taker. So almost 70% of my funds are in investment stock and shares. So, but don't learn from me because it's too risky. I can take it because I haven't married yet. So I'm still young and have a long life horizon. Okay. Besides buying health insurance, right? I did not invest with my CPF funds yet. I personally don't want to touch it because CPF OA gives a 2.5% return and 4% return in special account. Those returns are guaranteed. So if I use this to invest in other assets, so those 2.5% and 4% will be my opportunity cost, which is too high to me. So I prefer to not touch my CPF funds. Yeah.
Okay, so for me, as a financial planner, I always talk to my client first, right? To ask them, of course, a few questions to get to know about their risk appetite, right? And then I'll give them my suggestion on how much they should invest in stocks or in bond or in other asset classes, right? For me personally, I'm also quite young, right? But I also have quite heavily invested in stocks, about 60 to 70% in stock market. I don't use CPF at the moment to invest in stocks, mainly because I still have free cash in the bank account that can invest. And just like William mentioned, right, to me, it's about cost of fund, right? If I'm using my cash in the bank to invest, then the cost for me is almost 0% interest, right? So I definitely would invest with that portion first. And of course, the cost of fund for CPF OAS is like 2.5 and 4%. So I will definitely use the portion with a lower cost of fund to invest. Yeah. So my suggestion is do a proper planning, all right, and then to understand your allocation, how much you should invest, and also about your horizon. Okay, if you need the fund within like next 2 to 3 years, then stock market is probably not suitable for you at the moment, right? So do a proper planning first. Yeah, that's my suggestion.
I'll jump in next. I think the general rule is to set aside 6 months of your monthly expenditure as savings. So once you've set that aside, any amount in excess you can deploy. This 6 months is a general rule. I think it's important to say it's a general rule. You still need to look at your still need to do a thorough financial planning, and maybe you can afford Huan to do that. Okay, but still need to do a financial planning to see what are the expenditure that you need to set aside, but the rest you can then invest. And I think how to invest then depends on the individual profile of an investor. For myself, I think very similar to the rest of my panelists here, I usually try to do is to try to maximize the investments to get a better return on the capital. Now on the second question on CPF investments, yes, if you are looking to buy a house, then you need to weigh the consideration how much of your ordinary account savings you are using to pay for the house. Also note that if you use the money to pay for the house, you still need to pay the interest back on the ordinary account. So you need to weigh the balance between using your OA and cash to pay, because your OA is not free. When you sell the house in the future, you still need to pay the 2.5% back. I think that seems to be a common misconception that many people have. But having said that, once you've decided the allocation, there's the CPF rules require you to set aside to at least have a minimum sum inside there, and the rest are investable. So if you can get a return that is more than 2.5%, then I think it's definitely a good tool to invest. Personally, I've used the CPF account to invest. I think that increases the flexibility and the options that you have when it comes to investment. Yeah, that's all.
Right, thank you. Yeah, I think for the CPF part, we do have differing views, which I think both Louis and William is mainly looking at the point of the cost of the funds, right? Where Terence is looking at more of the flexibility, because maybe perhaps some of the investors are the young investors. They might not have a lot of cash on hand, but they do want to take part or try out their hand at investing. They might consider using CPF, but do take note of the risk involved. Right, so let's move to the next part. But before that, along the way, while we're having this discussion, feel free to actually join in to actually ask any questions you have or any points that you want us to discuss during this session. All right, so for next one, we're looking at, do you actually trade on only counters you know and very familiar with after very intensive research? Or do you actually look at trading opportunities that you actually see due to the short-term swings of the market condition? Yeah.
William here. Okay. It really depends. If for long-term investment, I will do my own research because it gives me faith and confidence to overcome the market downtrend. But if for the short-term trading and or the contract trading, I normally look at those hot counters with high trading volumes. I normally do a technical analysis, and I will prefer to read on the trend. So that's my strategies to different path for investment and trading. Yeah, Luis.
Oh yeah, for me, I actually more on fundamental, so I definitely will need to understand the company more before I invest. And also as a reminder, I'm also a reminder. So when I talk to client, I always suggest them, invest in stock that you follow, okay, you know, all right, and you don't have to have so many stocks in a portfolio, all right. If I'm not in this industry, if you ask me to monitor stocks, I think it will be quite tough. Right, so I guess is to find those stocks that you're familiar with and probably look for counter like between 10 to 15 stocks and to construct your portfolio and just focus on monitoring these stocks and probably have another 10, 20 stocks in your watch list. I think that will be enough to construct your portfolio. Yeah.
For the approach from the research department is that we do a deep dive into the counters that we cover. And when we say deep dive, what that means is conversation with management, and we do that a lot. For the research department, for some companies we actually have monthly calls with some of the management. So we call Capital Corporation up, or we call the investor relations team from Samcom Industries up. And then we have meaningful conversations. So our approach and that kind of work then translates to the way that I do my investments, which is that you only invest when you have a very solid understanding of the company. And as part of our work, what we used to do, actually even pre-COVID, is we used to travel even to the operations of the countries that they have overseas. So you get to see for yourself the factory and the operations that they have, and also the way that they conduct their businesses. So that is important to get a good understanding. I think some of my panelists here also talk about a solid understanding of the company before you do that. And also the next thing that is very important for us, that I think is sometimes omitted from financial statements, is the quality of management. We try to, as part of our research due diligence, we try to assess this and also try to convey this to our clients as well. But the quality of management is important, because if the management is competent, the management is honest, the management has integrity and is good, then those are very compelling reasons for us to also invest. These are not things that you can get from reading an annual report, unfortunately, but these are things that you can get when you have face-to-face conversations with this management. And that kind of deep understanding then gives us a lot of comfort when we invest in the company. So really, in summary, a deep dive, good understanding of the management, good understanding of the operations, and sometimes that means kicking the tires.
Actually, I agree with Terence about this deep understanding about the companies, because I just shared one of example because I have a face on this China EV stocks called NIO is the new. So I watched almost every the conference talk with the CEO, the chairman, and also the new day they organized. So I will look at all those of car forums about how does the public, how does the customers look at their cars. So that gave me confidence. I mean, just beside to reading the financial reports, and I have a clear vision. I agree with the CEOs, and so I believe that the counter will achieve higher in the future. So I agree with Terence about this part.
Right, thank you. Right, so much envious about the research team ability to actually visit the companies. All right, so basically, yes, we do want to understand the companies, and what William have also shared is to understand and believe in the story of the firm instead of just looking at the fundamental numbers, for example. Right, so okay, going on to something that's a bit more less typical question during an investment seminar, right? A bit more light-hearted. I want to just check what is your opinion, personal opinion, on to what extent do you think luck, right, general luck, or skill play in a part for trading for short term? Like if you trade for short term, do you think it's purely luck, or like is it a semi-gambling idea, or you're looking at a skill? Is a skill involved in the trading? Yeah.
Okay, William here. Okay, for short-term trading, I definitely we prefer we hope we are lucky, and we hope the trend is the correct prediction. But the luck is not, we cannot measure, and we also cannot control. So the skill comes in. Okay, the skill is not only the technical analysis, but for me, right, for my belief, if we would like to earn money or something, we need to follow our plan and the trading strategy strictly, because we need to overcome our own emotion. We need to plan before we buy the shares, sell the shares, how much the size, the trading size we need to buy, because we need to calculate how much the downside we can bear the risk. And after we buy the shares, then we need to set a stop loss point, which is cut loss. This one we need to follow strictly. Don't let your emotion control you. Okay, and also you need to set a stop is the taking profit point. When the price reach that point, you need to follow it, follow your plan. I think that strategies makes you win the battle, win the war. Yeah. If without the trading plan, even though the luck is with your side, and you see the price up and down, and in the end you still lose money. That's my view.
Okay, for me, I don't think luck play a big part in investment, but I do see that sometimes, especially for me, when I pick those good fundamental stocks, of course I do use technical analysis to do some timing on the entry, but you know, there are always some corporate action, corporate news that we will never know that may happen in the near future. All right, so then whatever good stock, good numbers they will see, it may, I mean, the stock price may just drop or even like sudden surge. So there is certain part of luck in place, okay, but I don't think we should rely on luck to make money in stock market. I don't think that's sustainable, right? And also, even if you make good return or probably some losses caused by so-called luck, it is about how much you make and how much you lost. It's not about, you know, I got some profit from this stock. It's about how, in dollars terms, how will this profit affect your life, right? That's why that is also bring back to my my core business, which is portfolio allocation. How much do you plan to invest in one stock? If you invest just like, less than 10% or even 1% in that stock, and you're lucky, you make good profit for that 1%, and that is not going to change your life, right? So, and you won't put 100% in one stock, right? Then that is completely gambling to me, right? Yeah. So to me, it's about overall portfolio winning and not just a single stock or single trade winning. Yeah.
I think I don't really believe in luck when it comes to investing, but I think timing is everything. So you having a good grip of the market, and also having a watch list of different stocks that you have confidence in. And this watch list of stocks, when sometimes they do trade at a good discount, maybe because of the Ukraine crisis or because of the oil prices, and you start to see a meaningful correction of the price to their intrinsic value. And when we say intrinsic value, as an investor, what we mean is the fundamental valuation of the counter. What is SIA worth? What is the true value of Singtel? What is the true value of SETS? So to ascertain, the first step is to first know the value of the stock that you're buying. What is it really worth? It's the same as buying a property. If you look at a property at River Valley, you look at a property at Holland V. You internally as Singaporeans, I think Singaporeans are great property investors, by the way. But if you talk about property investments, people know what the price of a condo is in River Valley, or they know what the price of a condo is in Holland V. And that same kind of thinking, I think, is critical for stocks. You need to know what the value of the stock is worth. If SETS is trading at $3, is it considered cheap? Maybe, because you know the fundamental value. This is not necessarily advocating for SETS, but you know the fundamental value. You know it's cheap. So from the research department, that's what we do. We try to take a more scientific approach to valuations. We try to ascertain the fair intrinsic value of an investment. And sometimes when the counter takes a big hit and it's a good discount, we then try to snatch these opportunities as well. Yeah.
Right. Thank you. So actually, this question that we have just answered actually ties in quite nicely with one question from the audience, which I think is a bit interesting. So the question is from, I think, whether or not if you buy a blue chip with a sound FA, fundamental analysis involved, right? It's a very good FA initially, but you buy it on a timing based on TA, based on technical analysis, right? When the situation changes, right, should you cut loss, right, or keep the counter for long term? Because they say that you might actually consider, if you buy using TA, you sell using TA. But if you buy using FA, you sell on FA. But in this case, it's a good FA counter, but I bought it using TA timing. What should you do if the timing or the price drop? Yeah.
Okay, William here. So regarding these questions just now I shared, before you buy the stocks, you need to set your trading plan, where to cut loss and where to take a profit. So once the price reach either stop loss point or profit taking point, you need to follow your plan strictly. That's my view.
Okay, for me, I think the question is asking if person buy based on FA by use TA to entry, which is what I usually do. I mean, to me, the strategy is still based on FA. Okay, I use TA to enter so they have a higher. We enter with a good stock with a good momentum, all right, so that we can probably see a faster recovery in share price, right? And of course, the main idea of picking this stock or investing in this stock is still on FA, right? So when you say when situation change, okay, if the situation change will affect the fundamental of this company, then of course I'll take out my investment. But if the situation is because the general market sentiment change because of macroeconomic event that move the market sentiment, that is more on TA movement. So in that case, I will continue to hold on to the share, right? In fact, if the price drop, right, to a level that I believe is even more undervalued, and I see my portfolio allocation is not a big exposure in my portfolio, I will continue to average down. Yeah, that is my view.
I think, Huan, to answer your question, it really goes back to what the intrinsic value of the company is worth. A 2-bedroom condominium at Orchard Road going for $1 million is cheap, no matter whether you look at it from a fundamental or technical perspective. I think having that kind of knowledge, that kind of certainty that, what a 2-bedroom or 3-bedroom condominium is worth in Orchard Road, for example, will give you that kind of clarity when it comes to investments. So I think when we look at valuations is not cast in stone. When we look at a company at any point in time, when we look at SIA, for example, or we look at Alibaba, for example, the valuations that we derive on Alibaba or SIA today is not good. It's not impermanence. It's not till infinity or eternity. SIA is always going to be $10 because business conditions change. The economic climate will change. And because of such factors, these things do weigh on the valuations of the companies in the long term. So we need to consistently adjust our expectations. The valuations that the metrics that people use to value Alibaba, for example, has changed over time. I think some of the speakers here in the earlier presentations alluded to that. So when the valuations change, the question then is, what is the price relative to the valuations? You can use fundamental or technical approaches, it doesn't matter. But if the price has deviated very, very sharply from what we think the valuation should be, for example, maybe an example will help. If our valuations of SIA in the long term is, and this is a fictitious example, is $6 and it's trading at maybe $12, then we think that that kind of valuations need a re-rating. Whether you look at it from a fundamental or a technical perspective, we will still adjust our position, and that's how we take our approach. In summary, valuations, the intrinsic value as a guiding light, and that should affect how you make your investment decisions, especially when you know that what the intrinsic value should be.
All right, thanks for the opinions. Right, so personally, I also agree. Mainly, I would try to see what led to the change in the situation. Like, is it a fundamental reason or just a macroeconomic reason? All right, so moving on next, right? So we always say that diversification is there, especially for Louis, you mentioned for portfolio management, even diversify, maybe 10 to 15 counters. But personally, do you agree with a broad-based diversification, meaning across all the sectors, across maybe different markets? Or do you actually prefer thematic investing that have a growth trend, like you really believe in ESG or you really believe in green energy, and you put all your money in this sector, in this team, but it's diversified? Which approach do you prefer, or do you think?
Okay, maybe I share first. Louis here. Like I mentioned, I'm really looking at overall portfolio perspective because I'm wealth manager. I'm looking at overall wealth situation, right? My always the rule of thumb that I always have for me and my client is don't over invest in one particular sector, all right? Even no matter how confident you are, right? Yes, you can invest a lot, but the thing is, you have too much concentration risk into particular sector, right? So I always say, don't invest more than 30% of your total portfolio size in one sector. Okay, so if you do that, if you follow this rule of thumb, then your portfolio will have at least 3 sectors, right, in your portfolio, right? And then within that is a sector allocation. Okay, and if you look at individual stocks allocation, I also emphasize to have diversification. Don't over invest in one stock, right? No matter how unvaluable is the stocks, right, it may take long time to recover and end up your portfolio will just stay at low level, right? So don't over invest. My rule of thumb is don't invest more than 15% in one stock, right? So by doing that, you probably will have 10 counter in your portfolio, right? And of course, on a higher level, right, I also talk about asset allocation. Don't put everything in stock market. Right? You also have bond and other asset classes that can invest. All right. So that is my take. Yeah.
Actually, I fully agree with Louis about this point because diversification actually reduces the unsystematic risk. Because because this risk is not for specific. I mean, this risk is unique to the specific companies and the industry. We don't know which sectors today going up and which sectors today going down. So I normally allocate my investment across different markets like US, Hong Kong, and Singapore as well. So and I allocate those funds in different sectors and different industries. So sometimes when I need monies, when I need to liquidate my shares, I need to take a look about this my portfolio. So which sectors I can take money from, and doesn't affect the whole portfolios. Yeah, so that's my way.
Yeah, absolutely. I think I agree with the I agree with the rest of the panelists here. Diversification is really the key factor when it comes to portfolio management. Diversification is often said to be the only free lunch. I think I agree. So it's important to diversify your investments. When it comes to thematic investing, we do look at some more interesting themes that emerged over time. But one more critical factor that has come, especially from the research department's perspective, that's come into play in the way we think and do about investments is the theme of ESG. And I think Huan, you raised that up earlier in your question as well. And ESG is now from a research analyst point of view, it's starting to grow in importance, and it is starting to come into the research reports that the research department start to publish. We haven't done it very aggressively yet. We've done it in certain companies because we are cautious in the way we go about ESG investing, and I think it's a separate topic on its own. But I will say this. In the past, when the research analysts, when we do our work, what we do is we just look at the numbers, and then we look at their financials, and then we make a call on the company. But one of the things that we are doing now is we are taking into consideration ESG factors when it comes to investing, and we understand that it can be a little bit subjective in the way we assess as well. But what we try to do is try to find out what is important, and then highlight this to investors. And I think earlier on, for those who joined us in the earlier presentation, one of the things that we say is critical when it comes to the ESG. We think, or at least I think, okay, maybe it's not representative of the research view, is governance, the governance factor in ESG, because you want to have competent, honest management personnel that are running the company. And once you have honest and competent personnel, I think that if you have honest and competent personnel running the department, that is far more important than having people who don't necessarily have integrity when they run the company. And we have seen so many cases over time, and these are not cases that happened long ago like Enron. We have seen so many cases where companies management that are maybe a little bit incompetent or lack integrity lead to the destruction of the value of these companies over time, and that has seen many investors lose money. So governance factor is a critical element when it comes to investing, and we try to over time, what we try to do from the research department's perspective is to try to put this as a key consideration in addition to the other factors in investing in the company. Yeah, that's all from me. Thanks.
Yeah, thank you all. So since we are on this topic when Terence ended, right, there was two questions actually to follow up on the previous reply you did on how you actually assess the management. So in this case of governance, any factors, like any key factors you look out for? So like you're saying that how integrity and everything, but how do we define it, or how do we qualify the management on whether they are good or not? So how do you assess the management? Any way you can actually share to the audience?
Yeah, sure. Thanks for the question from the audience. When we think about management, and this is always very subjective. It's a good question, by the way, but this is very subjective because how you assess a person's character can be very subjective, and I don't necessarily think that I'm the best judge in this. But the way I look at them, I assess them. The first way to look at it is the manager, it means the CEO running the company, a manager or entrepreneur? And that makes a difference. An entrepreneur, I think, again, it's a very long topic, but I'll try to generalize this. An entrepreneur is somebody who is like Steve Jobs. You know, big vision, and he's able to execute on a plan. So those, I think those I tend to rank a little bit more highly, because you know you see the vision, they're able to execute, and then they lead to value accretion and value growth in the company over time. But if they are managers, that means that it means they're just followers, right? they're just managing it. All they need to do is go to the office and switch on the lights, and you know, just sit there and things run the way it is. So those they're not bad to ruffle feathers, but then generally entrepreneurs and managers, I think entrepreneurs tend to perform better. So that's number one. Number two, when it comes to integrity, and that's harder to gauge. How do you judge integrity, right? I mean, everybody's going to be honest when they appear in front of you. When they appear in front of you, everybody's going to be good. But how I judge integrity is, you need time to judge integrity. And how do you do that? We look at what the management say. We look at the targets that they set. If the management say, for example, they say, oh, we are going to hit $1 billion in revenue by 2024, for example. And then we track your performance over time. By the way, that doesn't mean that if you miss, it means that you've got no integrity. It's not that. But what we do realize is, sometimes there are some people who tend to over-exaggerate what they are able to do. They tell you, oh, next year, don't worry, we will hit $3 billion, you know, and then they come in, it's like $1 billion. And the reason, it's some crisis and everything. So you need to have a very sharp lens and look at those who do what they say they do. And sometimes, in my view, if they're able to over-deliver on the things that they say they do, that to me is a sign of a competent manager. You say, oh, we're going to hit our target, you know, by 2025, we're going to hit $1 billion, and 2025, you do 1.2 billion. That to me shows great competency. It shows that you have a good grip of the business, and also it shows that you are not sometimes over-exaggerating, and that to me shows a lot of good qualities. So yeah, thanks for the question. Very good question.
Okay, so let's move on because of time, right? So, okay, one more question that we have from the audience, which links up to my own question, is that when you actually do a portfolio allocation, all right, so do you prefer that the retail investor, let's only take low risk and high risk retail investor, should a person just invest in ETF plus one or two stocks that they really prefer, all right? Or they should make their own stock pick, like 10 to 15 of them compared to an ETF. So any opinion on what is the percentage or preference between the two? Like ETF plus one or two stocks, or your own portfolio construction?
Maybe I'll start first. I think I probably won't be able to give the percentage here, because they are so, I mean, I don't even know your personal profile, so it's quite difficult to quantify based on percentage. But on the other side, if you ask me whether to choose more stocks or more ETF, I think it's dependent on the person preference. Okay, if you are someone that you like to pick individual stocks, you like to have a specific exposure to a particular company, then of course stock is the only way you can go, right? If you pick ETF, you are the person, I just want to have some exposure in this sector, maybe in certain country like China, Hong Kong, then of course you won't buy individual stocks, because if you want to buy that one entire sector, you need to buy ETF or unit trust to get that kind of exposure, right? You buy one individual stock, it will not represent the entire sector or country. Yeah, so it's more about the what kind of objective you want to achieve, right? In order for you to decide to choose stocks or ETF.
For this part, actually, I agree with Louis, because for the fund management and also the security rep services to clients, we normally will assess the client's preference and also the risk tolerance level, and to make a decision or help the clients construct a portfolio. This, for example, if the client say, okay, I prefer those of dividend stocks, then we need to choose those of stock, I mean more blue chips, Singapore sectors. Yeah, but if the client say, hey, I'm a high risk taker, I prefer those of high growth stocks, then we may look at those of stock is with more PE, the higher PE. Okay, so this really depends on individuals' need and the preference. So it's very hard to recommend. But for me, I prefer maybe for retail investors at the one time in doing a trading or something. The number I prefer is five stocks, and more than 5 stocks I would feel very I cannot focus. I will lose the focus. Yeah, so I cannot trace the share price very efficiently and make a decision very clearly. So that's my personal experience.
I think if you don't have a lot of time to monitor your investment because you have a lot of other things to do, and you don't really know the sector so well, but you really want exposure into the sector. For example, you really want exposure into the cybersecurity sector, but you don't really know what are the things that cybersecurity companies do. You don't have a lot of time to look at these companies. And ETF is a great investment because it gives you exposure, and it's pretty low cost as well, and then you get exposure very quickly as well. But the issue with ETF then is you sometimes end up buying things that you don't really want, that is part of the whole entire basket. So you just have to weigh what you want. It's better to just buy what you want, right? But if you don't have the time and expertise in a particular sector as well, just go for ETF. That's all.
All right. Yeah, great. Thanks for the sharing. Okay, next one, I want to just join 2 questions together from the audience. So one point is for short term or mid term per se, like let's say 1 to 3 years, what is the recommended, let's say, percentage? Like I think William mentioned about the stop loss level that you can set. What's the recommended stop loss level that you could potentially look at as a broad level, as a brief guideline for between Singapore and US counters? All right, because I think unlikely they will be the same, right, as per us by the audience. Second part is that, do you think TA or FA is more important in this 1 to 3 years outlook aspect? And of course, I know some of you use both, but the idea is that how fast or how frequent should you review your TA and FA? Because not all of us, like financial professionals, they don't look at the market all the time. So what is the recommended, or let's say, what is your perception, or what is a good review period per se? Ignoring, let's say, short-term spike events, but let's say on a review basis.
Okay, I share first. William here. Okay, for Singapore market is different, totally different from US market, because the US market up and down is very fast and very liquid. So for Singapore, okay, for the cut loss points for Singapore stocks, especially for penny stocks, I may look at those of the beat. So let's say I normally trade the penny stocks when the share 1 bit up and 1 bit down is around $50 or $100 or $150. I will measure the beat. But for US counters, I may take a look about the percentage up and down. So I say, oh, today if the share price drop 10%, then I cut loss. So how much I can suffer the loss? I can tahan, right? So it really depends on the different of these 2 different countries. Yeah. So come to the how long to review the portfolio, the strategies, and normally review every month to see, okay, what I did is good and what I did is not good, what caused me lose money, what can I learn from the losing of money? Is it because I didn't follow my trading plan straightly, or is it because my TA is stocks or something like that? So I need to find out the reason. Yeah, because the market let me lose money, I need to learn from that. Yeah, at least that's what I can take from the loss. Yeah. Hope I answer the questions.
Okay, so for me, honestly, if you're talking about 1 to 3 years, is TA probably is more important, okay, especially for those like 1 year time. Even because if you find a good undervalued stock with good fundamental, you still need to have some form of catalyst to move up the share price. Okay, it could be earning turnaround, it could be someone buy over the company, or it could be some event that trigger the share price to move up. So that's why if you are looking for this kind of horizon, like 1 to 3 years, you definitely need to buy to those undervalued stock with a good momentum, right? Good rising momentum with technical analysis, right? So that will help, all right. And in terms of frequency of review of your portfolio or stocks, right? If you're a fundamental person, you should have some form of push notification from a system, okay, whether it's an app or a software that tell you what is happening to that company, because there are so many corporate action happening almost every day, right? So you must be aware whenever there's any corporate action or announcement from the company. Right. So I understand SGX do have a stock app that will help you to set up a watch list, and then you can set the alert so that whenever there's an announcement for that particular company, you receive notification on your phone. Right. Then you must read. Right. You must read. You must understand how will this affect the company. Right. Yeah. So the frequency that is depending on how frequent they announce. Right. But on a monthly basis, I also do a portfolio check, okay, to measure my allocation on the stocks, whether is it overexposed or the sector is it too much weightage, okay, and I'll do some rebalancing when I see then there is a need to do rebalancing. Yeah.
Yeah, so I think there are two parts to the question. So I'll take the first question first. I think when it comes to portfolio construction, for me, is about overweighting what you know and underweighting what you don't know. So because we cover the Singapore markets and there's home ground advantage as well, we sometimes get a personal touch with the investor relations team and the management as well. So sometimes we do get a closer feel of the company than say a company in Hong Kong or in the US, because in Hong Kong and the US it's sometimes a little bit it's a bit far, right? You don't get that kind of interaction. So if we have a good sense, we have a good feel, then we tend to be overweight this. If we don't have a good sense, then we don't want to allocate too much of our capital into that. So that's the first question. The second question on stop loss, we tend not to think so hard about stop, especially when it comes to portfolio constitution. We don't think so hard about having stop losses in place unless you use margin financing, CFD, or share financing. And I think Phillip gives good rates. If you want to know more, you can probably go to Huan or William, and they can probably advise you on the share financing and margin financing rate that we give to our clients. But again, we look at the fundamentals of the company. We're not going to do a fire sale just because the share price comes down. Again, unless you have margin call, right? But if the value of the investment remains sound, then short-term gyrations in the market will not make us sell. What will make us sell or change our thesis or okay, like we just sell the stock, is when a fundamental deterioration fundamental deterioration in the fundamentals of the company is present. Maybe the original thesis is gone. The reason why we invested in the company is no longer there. They're no longer doing the things that we think. And then that affects the fundamental value of the company, then we will sell. Because it's not like the government announced some cooling measures and then the property price come down and then we sell our condo at Holland V for cheap, right? No, because we know the value of the condo in Holland V. even things that happen, maybe a war or something, won't make us change. But if there's maybe some key differences, maybe somebody did something or committed suicide, like then the value could change. Sorry, yeah.
All right. Yeah, thanks for sharing on that part. Okay, so next one, right, I'll make it a more of a dilemma for many retail investors that I see and interact with as my role during my job. Right, so it also correlates to another questions asked by one of the audience. All right, so basically, right, the audience question is that is there any minimum volume we should look at for the trading of a counter? All right, to actually ensure there's tradability or liquidity. All right, the next part to it for me to make it into a question for what normally we interact with retail investors is that if let's say now I only have 10,000 for the year ahead, how should I allocate it at this point of time now? Should I throw all in one shot now, or do you still want to actually do a averaging method with this 10,000? Is this the outlook that I have for the year?
Okay, maybe I share first. So if the 10,000 is for trading, I may still prefer to look at one or two counters, because you need to understand every trading buy and sell, you need to pay the commission, and that's also a cost to me. And also the short-term volatility is not so high. So in terms to make money, I think do not. I mean, for me, I don't want to diversify too many counters. But if for long-term investment, let's say if I would like to enter one counter, like say Alibaba or something, I say, oh, current price is $100. I may weigh in first, or maybe one third. If the share price drop below how many percent, then I enter another one third, and from how many percent, then I enter the rest one third. To average down. That's for long-term investment. That's my strategy. And just back to just now the questions. So for Phillip Securities, we have this function called stop loss for US market. I found it is very useful right now, because previously I set the stop loss is manually, but now I can set a GTD stop loss for US counters. So after I buy the stocks, I can set a stop loss point for 1 month, just put there. So the system will automatically help me generate the stop loss. So it's very free to me right now. So I just back to just now the question. Yeah.
For me, I always talk about portfolio level, right? Whether we have 10,000, 100,000, to me, it's the same. It's about percentage allocation, right? But like what Huan asked about, let's say if you talk about this year alone, right? How you allocate 10,000 or 100,000. I think on the top level, you must have some view on the market, right? Whether you believe that this is a bullish market, or right now is a good time to invest most of the money in stock market. So you should have some form of view. Right. So let's say if for me, I believe that now market is more undervalued. Then out of this 10,000 or 100,000, more percentage part in stocks. For me, I'm 70% in stock market. I still have 30% because I don't believe market is at the bottom. If market really at the bottom, then of course I'll increase to 80% or 90%. Right. If market is very topish, like probably last year, or probably reduce the weightage to let's say 50% in stocks and the other 50% in cash. Right. So that is the first thing you should have. Right, to decide what is your target allocation, right? Then when you decide on that, then of course you work out the numbers, how much you will invest in stocks, and within these numbers, also don't invest everything in one stock. You have to split as well, right? But if your capital is rather a bit smaller, you need to also take note about the transaction cost. Right, you don't want to buy $100 and now you pay $25 commission. That is 25%. Right. So the good thing is, right, Phillip don't have minimum commission for certain accounts. So you have to find out the transaction cost to decide what is the minimum quantum you should invest in the stocks. Yeah, that's my take.
Yeah, so I think some very great answers from the panelists. For the way I think about it is, having gone through so many market cycles, is the timing the market is you're often wrong. I haven't seen somewhat so competent to be able to time the market well. So instead of trying to time the market to say, oh, it's cheap now, or is the market top? I've seen so many market and analysts call the top, right? Oh yeah, or they say it's still low. The Dow is going to 50,000 or maybe 60,000. So timing the market is, to me, a fool's game. You shouldn't try to time the market because sometimes you never truly know. But time in the market sometimes is a better approach. Which means that you take a position and then you build it up over time, and then you grow your position over time. It becomes a little bit cheaper to the fundamental value, then it's probably a good time to invest. So building that kind of stakes, growing your recurring income, and building on those positions that have proven themselves over time, I think is a more sound approach. If you have $10,000 to invest, again, alluding to what I said earlier on, overweight what you know, underweight what you know.
All right. Okay. Thank you. So, due to the time, I think we will touch on the last question, but let me try to pack a bit more into it. So basically, what I can discuss is this. So you can actually see, let's say, there is a lot of AI investing, right, or robo investing team right now. So any opinion on this aspect? And also, right, one last part of it is that if you actually want to trade on the SGX market right now, okay, is there any company or thematic play you are actually focusing on currently? Right, not saying that definitely only this is available, but currently, what is your best team pick or best sector pick that you personally believe in, along with the robo question? Yeah.
Maybe other panelists can share first.
Okay, I think there are two questions. The first one is about robo. Second one is about sector, which sector may perform well this year, right? I'll probably answer the second one because that's the easiest. It's about, I think everyone is talking about rising inflation, rising interest rate, right? And also now, of course, Singapore is reopening play, right? So I think in our portfolio, we should have these three sectors in our allocation. Okay, rising inflation play, okay, which is like finance stocks, all right, and then rising inflation, which is the commodity stocks, all right, and then reopening play, okay, those hospitality REITs, aviation sector. You should have these three inside your portfolio if you talk about this year, right? Robo versus human, or rather advisor kind of portfolio investment. Honestly, based on my experience that I've met almost like 1,000 to 2,000 clients over the past 5 years, robo is still picking up. I do see that some of my clients do invest some portion of their investment capital in robo-advisor, but most of the time when I see the capital is not large, it could be because it's something new, right? People are not so familiar, right? And for me, I don't invest in robo because I want the better control. And I'm not tech savvy. I'm not sure how the algorithm work for robo-advisor. So I'm also a bit worried if I say anything go wrong with the system, then the algorithm may change all this. I'm not sure about that. That's why even if I'm going to invest, I won't invest a lot, right? I want to have better control with the money that I have. Yeah, so that's my take.
If I can take some of Louis' answers, that'd be great. Yeah, so for me, I share a similar sentiment as well. I don't know if it's robo investing or human investing, because it could be a robot, but the humans behind doing it. So I'm a little bit skeptical in terms of how the robo is so automated in terms of the kind of smart technology they claim to have. So yeah, similar to Louis' view. On the second question on some of the themes that we are looking at, also quite similar to Louis, but I'll probably add on that in terms of the reopening stocks that we are looking at some. We think that this will come back in a big way. We're obviously looking at some of the hospitality sectors and also the travel place. We start to see, when we look at the statistics coming out of Changi Airport, we've started to see a meaningful pickup, especially in the first quarter of 2022, in terms of the number of travelers coming in and also leaving the country. And we think that this is poised for recovery. Another sector that we think will see very strong growth, especially in 2022, is the construction sector. And we're selective on some of the construction companies that we are looking at, because they are not all the same, but we are a little bit more bullish on PRC Asia and Pan United, mainly because they are market leaders in their field. Yeah, that's all.
Okay, William here. Okay, for the robot advisor of this robot trading services, actually I didn't try out. But according to my clients, they still prefer a human touch. So they still prefer a representative and also a wealth manager. So that's what I can share from that part. And for the sectors to invest in, I agree with Louis and Terence about this. The airport, the reopen phases, and also the high inflation, the high interest rates benefit the banks counters. But besides that, I still look at those of Singapore newly listed specs. So that three specs I also monitor very closely, because current price are trading below their IPO price, is below $5. So I still want to see what's going on in the future about these first three spec counters. I believe the government or the SGX doesn't want these first three project view. Yeah, so I still look at that sectors.
All right, thank you, everyone. I think thanks all the panelists for Louis, William, and Terence for sharing. Right, so we reached the end of the session. I'll pass the time back to Edward. And thanks everyone for joining this session. I hope it was a meaningful discussion for all of you. Right, Edward, back to you.
Thank you very much, Huan, and thank you also to William, Louis, and Terence. That was an incredibly diverse and broad range of topics that they covered back there. If you're just joining us and you're wondering, what did I miss? Not to worry, the recording for this session and the sessions earlier will be available very soon, as well as those from last weekend. If you missed out on them, please do make sure that you check out the recorded sessions button, because you will be able to watch them again at your leisure, but only for the next week. That's to say, this will only be available until the end of next week.